Good afternoon, and welcome to what we hope will be an educational and impactful discussion on renewable energy tax credits. My name is Tyler Beatty, and I'm an assurance partner in Forvis Mazar's renewable energy practice. With me from the firm today is Ben Walters, who's a tax director in our renewable energy practice, and Jennifer Sanders, who's a tax partner in our banking and financial services practice. Along with us today are some industry experts and friends of the firm, Josh Miller and Bill Hovinger, who are with Key State Renewables, which is a division of Key State Companies. For those of you who aren't familiar with Forvis Mazars, our network includes over $5 billion in combined revenue, spread across over 100 countries and 40,000 plus team members. Our U.S. presence includes a top 10 U.S. public accounting firm with over $2 billion in revenue, with offices in 28 states and clients in all 50 states. Our renewable energy practices spends a significant amount of time working with utility scale IPPs, asset managers, institutional investors, and tax equity funds across the United States, beginning as soon as the project begins greenfield development, through construction, projects placed in service, and the accounting and tax compliance that comes along after that. And I'll pass it to Jennifer to talk about our banking financial institutions practice.
Good afternoon. Thank you all for joining us. I'm happy to be here with you all. I did just lose power. So I literally just got on, as Tyler was saying. I'm going to kick it to Jen. So technology is great, except when it doesn't work. So I am a partner in our financial services practice. I've basically spent my entire career in banking. And just a little bit about our banking practice: we are the #2 auditor of publicly traded banks in the country. And we work with 7 of the 10 biggest banks in the country, as well as over 1,000 bank clients. So just a little bit about our practice. If you have any questions about our banking practice, you can please feel free to reach out to me or any other member of our financial services team. And with that, I'm going to kick it over to Josh.
Thanks, Jen. So today we're going to spend some time talking about our Key State's Sole Cap tax equity platform. But Key State has been working with community banks for over 30 years. We manage investment subsidiaries for financial institutions and community banks. But our most recent business line, which was launched in 2019, was the Sole Cap Solar Tax Equity Platform. It basically is a platform that brings tax equity investment options to community banks from across the country. And it's been well received since we launched in 2019. We kind of doubling each and every year. So through the end of this year, we will have raised and deployed $450 million in tax equity, all for community banks, and funded over 100 solar projects and solar and battery projects around the country. And we'll talk a little bit more about the return profile, but as you can see here, the IRR looks pretty compelling. So we'll explain how that comes to pass. So solar tax equity, I'm sure many of you, at least our bank customers or the banks on the phone, may be more familiar with other types of tax credits, like low-income housing tax credits or new market tax credits. But solar tax credits have been around since 2007. And all of the large, pretty much every Fortune 100, every large national bank, every super regional bank has been participating in this marketplace for quite some time. And the reason is it's a very compelling return profile. This is a mechanism to essentially look at your federal tax liability each and every year and offset up to 75% of that tax liability with a solar tax credit investment. So that's the first piece. You're going to convert your tax liability into earnings and grow your capital each and every year. And you can adjust the size of that investment each and every year. So as opposed to other types of tax credits where you're going to make an investment, then recognize some portion of that tax credit over 10 years or 7 years. In this case, you're going to realize it all when the project is turned on in the first year. We also think for companies and for banks, this is a great opportunity to round out, supplement, enhance your corporate sustainability program. A lot of you are public companies that are beginning to, or you already are publishing an annual sustainability report or corporate responsibility report. This is a meaningful investment that is financing real projects all over the country. And we are focused on mid-sized projects, which I think pair nicely with middle market companies and community banks. And also, we're really excited. We've been focused since we launched on identifying projects that are structured in such a way where the developers are incentivized to sell some or all of the renewable energy to underserved communities. And we've just recently received approval from the OCC for a certain segment of our projects to receive CRA credit, a Community Reinvestment Act. So we're really excited about that. So first, maybe we can start with what is solar tax equity. So essentially, we're going to be providing one portion of the capital stack. So when a developer wants to go and build a project, they're going to put in some of their own capital, obviously. They're going to get a permanent loan, and then we're going to provide what's called tax equity. And generally, the project itself is going to be built with a construction loan. So all these dollars that need to fund the financing of this project, both the tax equity and the perm loan, are really not going to even close into the project until it's fully constructed. So in this example, this is a project that costs about $25 million to construct. Just roughly, that might sit on 50 acres in a rural area. I'm kind of giving a thumbnail sketch of some of the projects that we finance. Sits on 50 acres in a rural area. It's near a substation, so it can connect up to the grid. And this project might power 1,200 to 1,500 homes or households. And so how do we identify, how do we calculate that tax equity check? That is really the tax credit is driven by the fair market value of the project. So there's a federal tax credit, and the rate, there are a few different rates, but the most common rate is 30%. And I know that Ben is going to speak about that more here in a minute when he talks about the Inflation Reduction Act. So we'll have a project in development. We'll get a fair market value through a third-party appraisal, and they will appraise the project based on the expected cash flows. And the expected cash flows are actually quite easy to determine because the project is going to have a contract to sell power to either a utility, a municipality. In some cases, you can subscribe residents in a certain utility district or region. So that's a pretty known number, the revenue that's coming in. And then we do a discounted cash flow model, and we have an appraised value. So that appraised value is what you multiply the 30% tax credit to. So in this case, you've got a $30 million valued project times 30%. So the tax equity is roughly $9 million in this capital stack. One of the really nice things about this, besides the fact that, number one, you're not putting any dollars in when you're making a solar tax equity investment. The way these are structured is you put no dollars in until the project is constructed. And then even then, you're only putting 25% roughly of your capital into the deal. Then the project is connected to the grid and tested and turned on. And then you are going to recognize all of your credits and the depreciation flowing from that project. And only after that, when the project becomes commercially operational, 30 to 60 to 90 days later, do you have to fund the remaining 75% of your commitment. And that's also when the perm loan will close in. So that is really kind of demonstrating how front-loaded this return profile is. And we'll talk more about this, but really there are three sources of return when you make a tax equity investment. The first is, of course, the credits that are associated with the project. Also, depreciation that flows from the project. And when you add those two together, we were contemplating in the previous slide a $9 million investment. Typically, you're going to make the $9 million investment, or on paper, you're going to close on the $9 million investment. And then we talked about the timing of when those credits and depreciation are realized, very front loaded. You're going to get all $9 million back, typically in the first year or the first year and a half, because the credits and the depreciation are front loaded. Now, in the code, this needs to look and feel like an equity investment. So you need to stay in the deal under the code for 5 years at least. And during that period, you're going to get some preferred return during the first 5 years. And then there's a buyout feature in the 6th year. But that return of capital immediately in the first year is really a unique kind of attribute of this investment. And I'll say one more thing about that. When we have investors that are thinking about making an investment in solar tax equity, let's say today they're thinking about their 2025 tax liability. So they will commit and close into an investment on paper. But that project is then slated to turn on in Q3 of 25. So knowing that and having some certainty and a line of sight on that project being constructed, and we help with that, help our investors, they are going to start reducing, the investor is going to start reducing their quarterly tax payments accordingly. So you're actually conserving that cash throughout 2025 before you've had any capital calls. So it's kind of even supercharging that internal rate of return. This is, again, nothing new. Solar tax equity investments have been around since 2007. Every major Fortune 100, every large national bank, every super regional is investing in this in a big way annually. And so what we've seen is a shift. These big guys, they need scale. They need to make efficient investments. So they're the ones that are investing. I live in Las Vegas, so out in the desert. And so they're investing in these really large utility scale projects out in the middle of the desert. But there has been an explosion of small and mid-sized projects around the country that's been driven both by federal legislation with the Inflation Reduction Act that Ben is going to cover, but also by state legislation and incentives. And so it's those projects that we think are an ideal fit for community banks and middle market corporates because they're a better fit. In many cases, we can find ones that are more local or regional to that organization. They like that. And the return profile is better because they're smaller projects, so they're going to have a little nicer, higher return than the really big projects that U.S. Bank, for example, is investing in at scale. So there were a few things that have come together, I'd say over the last 2 to 3 years that have really piqued the interest of a lot of investors. I'd say probably one of the more compelling or the most compelling piece is the Inflation Reduction Act. Prior to this, the solar tax credit had started in '07, had been renewed 3 times, but it was starting to step down. And so with the Inflation Reduction Act, it extended for at least 10 more years. So there's a nice runway. Also, some things that we're going to discuss later, but all of this kind of coming together at once. There was a new FASB rule that came out in early 23 that allowed for proportional amortization of these solar tax equity investments. That's also been very helpful, I think, for investors, because before that it was slightly more complicated accounting. And the third piece for our banks on the line is that in 2021, the OCC released a new rule. It kind of laid out exactly how a bank can make a solar tax equity investment and what the regulatory authority was, which has been super helpful versus prior, the prior regime where you were basically submitting it in a one-off to your regulator. This is we haven't had any issues with banks of any regulator being able to make these investments as long as it's structured according to that rule. I'll turn it over to Ben to talk a little bit more about the features of the Inflation Reduction Act.
Yeah, thanks, Josh. As you mentioned, this is not a new credit, but with the Inflation Reduction Act, it has really supercharged the investment activity because, as you mentioned, with previously there was really kind of some question of, will this credit remain? Is it going to change? And now we have a really good 10-year runway to claim the credit for any investor. One of the key features is the 30% credit, which really it starts at a 6% credit. So you have to be careful now that we're in 2024. And we could spend all day probably having a series on the Inflation Reduction Act, but there was a period where you have grandfathered projects in that qualify for the 30% credit, but many of the credits now are going to need to meet the prevailing wage and apprenticeship requirements to get a 5-time multiple of the 6% credit to then get you to that 30%. So those prevailing wage requirements are very detailed. They are by employee. There's a lot of tracking for any contractors that may be on this webinar are probably very familiar with those by now. But I think the key point is those requirements are ultimately for the taxpayer. The owner of the project, they need to be well aware of those requirements because they will be required to report them to the IRS. If they're not met, there are penalties associated with that, $5,000 per employee, and it does extend throughout the 5-year life of the credit. So it has to be maintained and kept up with. But that is the key piece because the 30% credit is an important part to the economics of the deal. We've seen a lot of 30% credits. As you see on this slide, they go all the way up to 70% with various adders that are in place. There's the domestic content, which you can get a 10% bump. Energy community is fairly common. And then finally, low-income housing, which has 2 options depending on where you're investing in a low-income housing community versus which would be a 10% or a 20% credit. If you do the math, you could get up to a 70%. We're seeing a lot of 30 and 40% and some 50. If you can get all the way to 70, then you've really hit a home run. But with that, the other thing I've not mentioned here on this slide, but is a really hot topic is transferability. The ability now, which existed before with the production tax credit, but now it is also available for the investment tax credit. And this transferability feature allows a owner of the project to claim the credit and sell the credit. And I should rephrase, you actually are not claiming the credit, but you sell the credit to then monetize the credit, say that you're not in a taxable position. You could then sell it to another party who is in a taxable position and able to take advantage of that credit. and it's gained a lot of traction in the industry, quite popular. There's also direct pay for our tax exempt entities if we have any listeners from that space. But all these factors coming together are really supercharging the interest in this investment activity and these credits. But thank you, Josh. I'll turn it back to you, and feel free to add any things.
You bet. This presentation today is focusing mostly on solar tax equity investments, but we help our organization, and there's others out there as well, as you can imagine, are helping investors to place investments using the transferability provision. And so, like a quick comparison might be, we're working on one right now for some 2024 credits. 3 investors, a corporate and 2 larger community banks, are committing to a $70 million purchase of investment tax credits from a developer in the Southeast that's got a utility scale project. And so they're going to be buying those credits at about, let's see, at 93 cents. So their ROI on that investment is going to be 7.5%. And now that's just kind of like you're in and you're out. You make the investment, you realize the return. Now you still have to think about, you still need to diligence the project. You still have that ITC recapture risk, which follows through to the buyer of the credits, and we'll talk about how that's mitigated. But you can't disregard that. So that's 7.5% return. Now compare that to a solar tax equity investment, and what kind of the 3 sources of return that we talked about. I'll go flip to my next slide here. And remember, with a solar tax equity investment, you're getting 3 sources of return. You're getting the tax credit, you're getting depreciation on the project, and then you have to stay in the deal, and then you get some cash over a 5-year holding period and a buyout in the 6th year. So those returns really can vary. The nice thing is, if you're from a high tax state, you can potentially get some benefit from the deductibility of that depreciation on your state return. So, the return can vary from, say, 12% to 15 or 16%, depending on those factors. So significantly more return. It's really a matter of if the investor wants to make that equity investment. We found that, there are, for example, community banks that are familiar with that type of equity investment because they're already doing it for LIHTC investments. So it's not really much of a change for them to be interested in solar tax equity. And then corporate investors, I think, have been maybe trending a little bit more towards the ITC transferability. At least that's been our experience. So I'm going to now turn it over to Forvis to maybe Tyler to walk through or maybe no, I guess Ben's probably going to go through the first piece, but to talk through the tax and the gap profile for a typical solar tax equity investment.
Thanks, Josh. Yeah, I think Ben would be not happy if he was having to talk about GAAP accounting. So I'll take this one. And maybe one important piece on the transferability. The tax credit can be transferred once from the ownership entity that owned the renewable energy project. So after the tax credit is transferred, it cannot be transferred again for anybody thinking about trying to monetize a lot of tax credits and then transferring them twice. That can't happen. So, Josh, I appreciate you giving a quick introduction into a traditional tax equity investment and kind of what that looks like. What we want to do is spend a little bit of time, and similar to Ben's comment on the Inflation Reduction Act, we could probably spend all day or have our own webinar about how do we account for these investments from a GAAP standpoint, and at what level, what does that look like? But we did want to hit a snapshot, and then obviously could talk through any additional questions and additional detail offline. But effectively on the left side, right, we have the investor in the tax credits, which is a C corp, and they're providing cash in the form of equity contributions to a fund, which is typically a pass-through entity. And then that fund is recycling and providing that cash in the form of equity contributions down to a tax efficient partnership that we would typically call in the industry a tax equity partnership. And so that tax equity partnership usually has, number one, it's going to wholly own the renewable energy projects that are typically selling power under long-term offtake agreements to customers. But it's going to really have two classes of interest. One interest, which is typically called the tax equity or the investor interest, is going to be the tax equity fund. And then the managing member or the sponsor would typically be the developer, and that would be a separate class of interest. So the tax equity partnership, it would be a regarded entity. I think Ben and Jennifer are going to talk about the kind of the tax attributes on the subsequent slide. But from a GAAP perspective, so the tax equity partnership, it is a partnership. Typically, the LLCA and usually the tax equity partnership is going to have long-term project level debt on it as well. So there's typically audit requirements. And maybe one point of clarification is that the developer, the managing member, is typically responsible for the accounting and the financial reporting that happens at the tax equity partnership level. So this would be the level that the renewable energy projects are owned in. It would look more like an operational audit with generation, operating expenses. In certain instances, you would see income allocation split out between each member, the Class A and the Class B, or the sponsor and the investor member, in the standalone financial statements, which makes it a little bit easier accounting when we get up to the tax equity fund accounting. But it's not required, and it's really up to the developer whether they want to show those income allocations between the tax equity investor member and the partner member, the sponsor member at the tax equity partnership level. So then we get up to the tax equity fund, and the question is always, how does the tax equity fund account for their interest, which is typically the investor, the sponsor interest, in the tax equity partnership? And so typically what you'll see from an industry standard is the equity method of accounting, because usually given the rights and obligations, the tax equity investor usually has the ability to provide a significant influence, but they don't have a controlling financial interest, so they wouldn't consolidate. So they need to record their investment typically as an equity method investment. There's a couple ways to do this at the tax equity fund level. You can use the fair value election through the equity method of accounting. You can use HLBV, which is the hypothetical liquidation at book value, which is another mechanism to record your income loss at the tax equity fund level. Some folks just use the income loss as allocated or as required and dictated in the LLCA agreements. I think the important thing to remember is no matter what method that you use, because these entities are pass-through entities, and if you're using ASC 740, as you can see, the significant and as Josh explained earlier, one of the significant benefits from these tax equity investments are the tax credits, which are non-cash benefits. They're typically the reflection of those credits, particularly when they're not transferred, but they're allocated to the members. They don't show up on a financial statement of a pass-through entity in accordance with ASC 740. So because it's a pass-through entity, because the significant benefit that these partnerships are getting are tax benefits that are passed through their members, there are impairment considerations for each equity method investment, which provides for a little unorthodox accounting at the partnership level. But in most instances, you're going to see a pretty large impairment loss at a pass-through entity financial statement without the benefit of your reduction in the provision like you would see at a C Corp at a taxable entity. So then maybe to elevate one level higher, the accounting that occurs at the C Corp level, similar to the tax equity fund, the pass-through level, they're typically going to use the equity method of accounting to record their investment in the tax equity fund. Proportional amortization that Josh mentioned earlier is extremely important, and I think it simplifies the accounting for the C Corp and the bank. if you use proportional amortization under 740, the flow-through method for deferred taxes and tax is in accordance with ASC 740 is required. There's also a deferral method of accounting if you're using 740 under ASC 740, but you're not using proportional amortization. It's a policy election whether to use the deferral method or the flow-through method. If using the deferral method, the income tax credit would be recognized over the useful life. If it's a flow-through method, it's in the period that it's generated. And then if you're not using proportional amortization, you could always account for your investment using the hypothetical liquidation at book value, which is again is a mechanism to liquidate the partnership. So that's at a high level. Again, we could spend all day on the gap accounting for these investments. The last thing I'll mention before turning it over to tax is that we do have the opportunity and the expertise. So we provide services to clients at the IPP or the developer, which is the tax equity partnership level. We provide accounting services and have mutual clients at the tax equity fund level and then the investor level. So as you're working with your auditors, it usually helps if it's different audit teams, but the same firm. We find a lot of efficiency and expertise and collaboration that works as you're working through this. So again,
Tyler, I would just make one comment there, maybe just to kind of give people a sense. Ever since we've had this new rule come out from FASB in 23, I would say probably 95% of our investors have made the election to use proportional amortization method, PAM for short. Now, you have to make sure that the investment qualifies for PAM. There's a test or a two-pronged test. But I know from our standpoint, every investment that we are contemplating, every fund on a go-forward basis will be eligible for PAM just because of the popularity of the election. So,
yeah, that's a great point, Josh. And I would agree. I think that, again, if you qualify and you have to go through the codification, which we can help with to ensure that the project's eligible, I think what we've seen in practice, which was one reason I think that the FASB opened up proportional amortization to renewable energy because it had been there for LIHTC deals, is it's a lot less complex. It's a lot less convoluted than HLBV, which quite honestly and transparently, other than proportional amortization, is the other mechanism to appropriately reflect the economics of these deals. The issue with HLBV, and so what HLBV is for the group, is it's a hypothetical liquidation of book value between the partnership to see where the proceeds go. It's a balance sheet approach. It's quite complex to have the models. The models are complex. It's expensive to maintain, particularly for community banks and others that aren't doing a lot of tax equity deals. It's hard to maintain. And there's a lot of what I would call diversity in the practice of how you account for certain items. Like a perfect example that we have discussions about every day is, do you consider recapture in a hypothetical liquidation, right? So we're hypothetically liquidating the partnership, but if we were really liquidating, recapture would be considered. So do we consider recapture in a hypothetical liquidation or do we not? Our attorneys always, our attorney and legal friends always like to have complex waterfalls and liquidation provisions in the LLCA. So it's a point of contention really as well when we're trying to run a hypothetical liquidation of who's really getting what, and it's hard to interpret. So a lot of rambling, a long way to say, Josh, if an institutional investor or C Corp that's investing in tax credits qualifies for PAM, it's going to be a lot easier, likely a lot less volatile from an earnings standpoint, and a lot less headaches for the accounting on the go forward.
Tyler, a question came in. I think we can probably answer it here on this slide, but it is, what is an example of significant influence a tax equity investor typically has in these entities that would preclude the use of PAM? You didn't get into the details tremendously about the 5 criteria of PAM, but that is responsive to the criteria of PAM. The other criteria are financially driven. Substantially all of the proceeds are from tax benefits, and then there's also a positive yield from tax attributes. One of these other criteria, the non-financial criteria, are are you a limited partner, and is there a high probability of receiving the credits, et cetera. The significant influence question really gets to, well, if you're a general partner, and there are banks out there are community banks, there are large banks that are acting in the capacity of a general partner in the oversight of the operation of the company, of the projects, potentially of a fund. They might also have a lending capacity. But the trigger that would preclude PAM would be, are you a general partner? Do you have significant influence? And so there's the way our funds are created is that Key State is the managing partner, and that we hold on to that controlling interest so that we'll always be able to offer up the continued use of PAM.
Yeah, that's a good point, Bill. And I think what we're talking about, right, is that tax equity fund pass-through level. That's another regarded partnership, and I know for your platform, Key State is the managing member of the tax equity fund, right? So the tax equity fund presumably has a significant influence in the tax equity partnership, typically given its rights under the LLCA, but Key State, as the managing member of the tax equity fund, would be responsible for that significant influence. Did I say that right the same way? Just maybe a different way?
I think that's, yes, very accurate. Thank you.
Yep. And then Bill, I saw we had one other question about explaining the cash proceeds. So,
and I will hold on to that one until we get there, if that's okay.
Okay, perfect. Yeah. So maybe, again, I know you and I would talk proportional amortization and GAAP accounting all day, but we'll let's pass it to Jennifer and Ben and let them talk about some of the tax mechanics.
Sounds good.
Yeah. Well, thank you guys. Switching over back to the tax side of this, I think I'll start down at the bottom in reverse order from the direction you went, Tyler, and I'll start with the tax equity partnership, and then we'll flow up to the equity fund and ultimately to the C Corp investor, where Jennifer will talk about the tax implications there. But starting at the tax equity partnership, generally these funds are set up with a investment coming in that is often purchasing a member interest, and this can be done in a few different varieties, the most common of which is a partnership flip model. Another often seen model is the inverted lease model. But once that investment is made or purchase is made, the partnership now has two partners. You have the investor and the managing member, and we have a taxable entity at that point. One key item there is that when that investment is made, there's generally, I guess, a key difference I should mention between the inverted lease and the flip structure is that the credit for the inverted lease is determined based on the fair value of the project, where the flip is based on the cost basis. So a key piece that all individuals and projects will need is going to be evaluation related to this. There'll be evaluation and also a cost segregation or a cost certification that's going to take the costs of the projects and break them down between the eligible versus the ineligible costs of the project, so that you have a good solid reference point if it were ever to come into question by your investors, the IRS, or if you were to sell the credit in a transferability, the owners of that credit or the people who claim that credit would then need some sort of document that provides good support that is auditable. Now, the valuation is a key piece, right? Because that is going to be what establishes the value for the credit. And, a lot of times these can come in a variety variety of different flavors. Where you want to be careful is that the valuation is not extremely different from the cost. You wouldn't expect some extremely different value from the cost basis or the purchase price. And that's, I mentioned that because that's become more of a hot topic with the IRS these days. And we're seeing a lot more activity from the IRS looking at the valuations. But at the lowest tier, the tax equity partnership, whether it's a flip structure, inverted lease, or other arrangement, the project will generate the credit at that level, and then it passes up to the tax equity fund. One of the issues that is common in these arrangements is, since they're being funded by a variety of equity and debt, the allocations for the losses, namely depreciation, right? There's, in year one, there's going to be a large depreciation deduction related to the project, related to bonus depreciation, which is phasing out over time. We'll see where that heads with the next election, but that depreciation deduction is going to flow out and can go through the owners and partners' capital. So often in these projects, you can have what we call 704B reallocations or 704B tracking that needs to be done. And you'll see point number 2 at the bottom, one of the key considerations for each investor or managing member would be the need for a deficit restoration obligation. That's an item that needs to be thought through, and is generally thought through in the modeling process of the project. The deficit restoration obligation is basically a guarantee that if the project were to go south, that the investor would then have to fund and restore that deficit. Now, hopefully that doesn't happen, but what that does from a tax perspective is it allows the ability to allocate losses in the percentages and the proportions that are desired. And so continuing on throughout the life of the project, in year one, you often see a large deductions flowing through. And then as the project is hopefully operational and successful, it's starting to produce income, debt's being repaid. And as that debt's being repaid from a tax perspective, basis is now going down, which can then shift 704B allocations again to between the various members. And what we'll often see is depending on the ownership structure, there may be guarantees in place that help make sure the allocations are going the way and the direction that are intended. So this is all done as point number 5, the performance risk and model integrity. Modeling for these projects is very important to ensure that the investor and the managing member are getting their rate of return that they're desiring from the project. So moving up the chain, this is generally then housed through a tax equity fund, and that's where the investors have then come together to contribute the capital to fund the project. This is more of a holding company, right? So everything from here flows out of the tax equity fund up to this investor C Corp, where the credit and depreciation deductions and the benefits are ultimately claimed. Right now, everything's at a 21% rate, but this is not a political discussion. But if there's discussion out there that rates could increase to a 28%. Well, that, in this world, that's actually more value to the renewable credits. A 28% rate, dollar for dollar credit, would actually spur, like you would expect, would spur more investment into this structure. So I think that gets me up to the investor level. Jennifer, I'll give you a chance to speak. You'll speak much more intelligently on that topic. So,
Ben, I did want to clarify. I know what we've seen in the industry when there's a misalignment of expectations, or we have a tax equity investor that's done a deal with the developer, made a tax equity investment, and the return's not what they expected it to be, maybe different from what they expected it to be. From my perspective, and I'm looking for you to either agree or disagree with this, it's really been number 5, right? The performance risk or the model integrity. It's very rarely been a performance risk of the project. It's we missed an attribute or it wasn't modeled correctly. for what actually happened. So I know you spend a ton of your time in transaction structuring and helping our IPPs and our developers to think through that. So I just wanted to hammer that home, and curious if you had any comment.
Yeah, no, I would definitely agree. The modeling is very key, and it's very important to this. And to do that accurately is what the investors are going to be basing their investment on. That's what the expected outcome is. That's not to say that things don't happen. Of course, you can have natural disasters. A hailstorm comes through Texas, and unexpected items. Another key item we've seen are interest rates. That was a big topic over the past few years, where you would model one thing, but then as interest rates creeped up, the expectations in the model would change and compress the return that was being received. Now, we've had a rate drop just recently, so that's a constant moving target. But to your point, I agree that it is the modeling. If that's not solid, it can cause issues.
Right, and I think that's one reason to look to a fund structure that has experience, and then also be working with a firm that can help you, to feel comfortable with the modeling that you're receiving from the developer. Because as a tax equity investor, your return profile, the way we like to explain it, is a known return profile, right? We know exactly the return that you should be receiving from the credit, exactly the return you should be getting from the depreciation, and the cash return, years 1 through 5, and the buyout are all formula driven. So there's nothing really that should cause that to have a variance. If it's any of the items that have been mentioned, as far as natural disaster, having to wait to get something repaired, etc., it's usually just pushing out the timing of the receipt of that return. So,
yeah, great point. Well, very good. Well, Jennifer, do you want to chime in on the impacts at the investor level?
Yes, thanks, Ben. So as Josh mentioned earlier, there are a lot of banks around the country that are investors in partnerships that generate energy credits. And so I have several clients that have done these. And one thing I did want to touch on, I know Tyler spent some time talking about proportional amortization, and I spend a fair amount of my my job, I guess is one way to put it, in the FAS 109 world. So I do not proclaim to be an expert on proportional amortization. I know a fair amount about it, but it's certainly, I think, more intuitive than the other ways of accounting for solar credits. It matches up with, if you do low income housing, I think it makes the accounting for solar credits more intuitive as well than the other types of ways you could account for this. And so to me, I was very happy when FASB expanded proportional amortization to include tax credits outside of low income housing, because it's more intuitive to account for that. So there's my little spiel on proportional amortization. So just wanted to cover a couple of things from the investor standpoint. Obviously one reason why you would want to invest in a solar credit deal is for the credits. And Ben spent a fair amount of time talking about the depreciation. And so what happens at the investor level is these credits are passed through to you via Schedule K1, as well as the losses. And so because of the bonus that you can take on the solar panels, then you generate this big loss in the first year, as well as you get these credits. And so it's a way to manage your tax liability, because then you have all these credits flowing through that are reported on your return. And as Josh mentioned earlier, you can also manage your estimated tax payments to account for these as well. So generally, the rate of return is pretty significant when you're comparing it to other assets that you could be invested in at the same time. One other thing I wanted to point out as well is, as Ben went through the structure, is you are going to get a Schedule K1. And so just keeping in mind, and those of you that already do these types of transactions or are in other tax credit deals are probably very familiar with this, but just being able to coordinate that with your tax return preparer and knowing that the timing of receipt of that K1 could impact the timing of receipt of your return, because as I sit here on 9/25, we still have C Corp returns that we need to get out by 10/15 because we're still waiting on scheduled K1s, even though those were due 10 days ago. So just something to keep in mind as well in terms of coordination with your return preparer and timing of getting that return filed. The last two bullet points I have on here are really bank driven. Just wanted to touch on the fact that, you know, CRA considerations related to investments in some of these solar tax credit funds, that CRA may be available to you, which may be important to you. And then from a regulatory standpoint, depending on the level of investment that you make in some of these solar tax credit deals, it could put you in a position where you may be limited in the amount of credits that you can use. There is a code section 38C, that you cannot wipe out your entire tax liability with general business credits. And so with the IRA, which Ben touched on earlier, there is the ability to carry back 3 years and then forward 22. But if you have excess credits in year one and you can carry those back, then obviously this helps you from a regulatory capital perspective, as you don't have that disallowed deferred tax asset in there, which impacts your capital ratios from a regulatory and call report standpoint. So just wanted to touch on those last two things. I know they're banking specific, so the non-banks on here, thanks for bearing with me as I went through that. So now we're going to the next slide, and we'll kick it back to Bill and Josh.
Jennifer,
Okay.
I was gonna make one point of clarification. Hopefully, I do not believe you're waiting on any K1s from the Forvis Renewable Energy Partnership tax team. So
or the Soul Cap team.
That is
either.
correct.
that's right. We like to hit deadlines.
That is a correct statement.
Well, I see we have 6 minutes left, and I'm going to try to keep us on pace here to keep going. This is a really important slide, and there's a lot of finance-minded, accounting-minded folks on right now, and they're all very interested in, you know, what does this look like when you put pen to paper or in a spreadsheet. And so this says national tax equity investment. That should say notional tax equity investment. That assumes that you invest $10 million in a tax equity, tax credit equity investment, such as SolCap. And you'll see that cash going out the door in the upper left-hand corner of the grid. And you'll see at the lower right-hand corner of the grid return, a cumulative return of $1.2 million. When you put it all together of what Josh had mentioned about the timing and the acceleration of recognition due to the credits, as well as the bonus depreciation or the accelerated makers depreciation that are available, it really shows an acceleration of the net income associated with these investments. You can see upper right is $851,000 in the first year for a $10 million investment. There's a couple assumptions related to that. Again, the level of depreciation, makers or bonus. This assumes a bonus depreciation exists at 100%, and importantly, no one's going to make this investment one-off. You might flex up and flex down each year because you might have an acquisition that you'll be able to add on more credits in a future year, or you might have some one-off expenses in any particular year, or you might have a divestiture that you'll want to flex up for. But if you were in a steady state and you took this over 5 years, then you would get to the point where you'd be recognizing, with an annual $10 million investment, $1.2 million a year. And again, these credits project out for a long time, 30% through the first 10 years under the IRA. It's important to also note, again, I know there are a lot of banks that are on the call. This is available to C Corps, of course. If you're profitable, if you're a C Corp, non-bank, it is available to you as well. You may not be as familiar with it as banks are because they've been investing in LIHTC and historic and new markets credits for a long time. But we tried to put some of these terms in, bank lingo. Banks like to see a return on investment. They want to see a return on average investment balances. And when you think about it in those terms, the returns related to making an investment, saving on taxes before you actually conduct the first placed in service, it really supercharges these returns. These are other assets under proportional amortization methods, so they're not going to impact your net interest margin. And there is no cost to carry, which is an important aspect of comparing LIHTC or historic tax credits, or certainly being a general partner in a fund. Those might result in different levels of recognition. And so the numbers that are presented here show that after the first year, you have an average investment balance of less than 5% of your notional tax equity investment. I'm going to keep moving here quickly. I'm sorry, I'm going to answer one of the questions that came out. What are the cash proceeds? It really shows here in this investment income column. There's going to be cash proceeds because you're a continuing investor in this, as Josh mentioned, for 5 years under the safe harbor rules of the code. And you will receive investment income each year. That is a preferred return. It's the first return to the capital stack. Moving on, I'm going to blow through this in about 5, 4, 3, 2, 1. And hopefully you've recorded your time getting your CPE. I know I'm 9 hours short right now for this year. It's important for ESG. Take credit for your ESG reports. Many of the banks are reporting this. SEC registrants are reporting this. There are some delays in what the SEC is requiring from an ESG perspective, but that's going to come around, and you're going to want to be prepared ultimately when the SEC does have more standards around this, and the bank regulators bring more standards around this in the future. You'll be able to take credit for your renewable energy investments. And then finally, this does not come without risks. And so the group talked about some of these risks as we've gone through the presentation. The most important part of the risks are that you understand them. You understand that there's a recapture risk, that there's a project performance risk, or a power purchaser risk. And as you go through your investment due diligence, that you understand how those risks are mitigated. And from our perspective, when we're underwriting, because Key State does underwrite the developers and the entire projects, this is what we're underwriting for. We underwrite this before we move on and try to fund these projects, so that we can answer these questions for our bank investors. And so there are these risks. We are at time. There's a lot to discuss in all of these slides. And I think from our perspective, we are more than happy to continue to engage here, go a couple minutes longer. If we need to answer questions, I'll leave that to the Forvis operations team here.
Yeah, I think Bill, Josh, I noticed there was a question that you flagged that you wanted to answer, and I would just say to our attendees that we appreciate it. This feels like we typically run long talking about renewable energy, and there's a lot of opportunity, and I think there's an amount of complexity as well, which is what Forvis Mazars is here for, and I know Key State, Bill, you and Josh are here for. So we're happy to stick on and take questions, and Josh, I'll pass it to you. But in addition to that, we're just wanting to give an appreciation for everybody that hung with us through it, and if we want to stay a couple minutes late, we'll answer questions as well. And if anybody has questions after the fact, please don't hesitate to reach out.
Yes. Yeah, exactly. Happy to stay on. And the next page, of course, includes all of our contact information. Um, it's hard. One of the questions has to do with whether the model that we talked about or this gap illustration would if this one does pass proportional amortization. I believe it does. That's all we're doing now. It's a little hard to show through this illustration. And there are two distinct tests that, when you run the model, we can kind of demonstrate that they do pass, even though they're getting some, some of the return is coming from that amount of cash that's coming back. And it appears that that makes up a large portion of the return, but there's some calculations that are occurring in the background. So this one does pass proportional amortization.
Yeah, I guess to be more specific on that, the cash that's received is less than the 10% criteria because you're receiving so much in tax credits. You're receiving, over $9 million in tax credits. You're receiving tax depreciation of over $1 million in this example. And so it's more than 30% of the net income piece. I see what you're saying. 463 divided by 1.2 million is greater than 30%, but the total benefits are actually the $9.2 million of tax credits, the $1.1 million of tax depreciation benefits, and the cash proceeds. So hopefully that clarifies it.
It's the return of capital is also included in that calculation. Exactly.
Right.
Okay. I think we tried to cover everything. There is a question on number 11 that's a little bit specific. So I'm thinking maybe Ben
Josh,
can take that offline.
Yeah, what I would say is we regarding that question, it's a specific question. I think Ben, if you can answer it, that's great. We do have a federal tax specialty team. They could answer that question directly, but I can tell you there are parameters or guardrails within the IRA that if a project's being built with federal grant money or something else, there's a bar to the investment tax credit. You're not allowed to double dip. So there are some parameters in there around that.
And I did see a question just came in on the regulatory piece. So the OCC rule, if it is structured in a certain way, which of course we make sure that all of our investments are structured to accommodate the OCC rule, that has been informally adopted by the FDIC and I don't know how I'd put it, accepted by the Fed. We haven't had any issues with the Fed, although they haven't formally adopted the rule. Essentially, you can invest up to 5% of regulatory capital and surplus into this specific asset class. So this would not, this is a separate silo from other investments that you're making into LIHTC or public welfare investments. So it's very hard for a bank to actually hit that limit just because if you think about the size of the investment versus your tax liability, even if you're doing a carryback, you've got plenty of room. And then if you're stacking these investments on each and every year, remember they're going to net down the moment you recognize the credits in a year. That investment sits on your books at a very low amount, usually about 5% of your notional investment. And so you have plenty of room to invest again the following year.
And that's really important because that isn't the case really with other tax credit investments. Some others are really capital intensive and stack on, and you'd never really be able to hit your 75% general business credit limitation because of the capital intensive nature of those.
Happy to provide, if anyone wants to reach out, we're happy to kind of model that for you. We're often asked to do a side-by-side comparison of a solar tax equity investment versus a LIHTC investment or versus some other investment. What you'll find is solar tax equity is unique in that because of the quick return of cash, right? You're conserving cash by reducing your tax payments, and because of the netting of the asset, you're using very little capital. So there's really a very small amount of opportunity cost to making this investment. usually you can make this investment and then make the other investment that you were also contemplating. Well, I think we've hit our limit. We appreciate everyone's time. Thank you, Forbes, for presenting with us, and we look forward to talking with any of you further that have follow-up questions. Please contact us.